Welcome to this week's episode of Jonathan on Money. This is episode number 136. This episode should drop the day before Thanksgiving, and on Thanksgiving, it is customary to acknowledge and give thanks for the bounty in one's life. In that spirit, I'm going to share some items in the world of investments and financial planning that I'm thankful for today and every day. I'm thankful that the U.S. stock market is the most transparent market in the world. I'm thankful that the U.S. economy is the most diversified in the world and has remained resilient when the markets of many other countries have been stagnant for years. I'm thankful for my 401ks and IRAs and tax deferred vehicles that give me the control over my own retirement. I'm thankful for SEP IRAs, simple IRAs, 401k plans, cash balance plans, and various other corporate retirement structures that allow my clients to save for their future while locking in extremely attractive benefits. I'm thankful for my own traditional and Roth retirement options so I can choose when to be taxed. I'm thankful that the U.S. stock market is the most liquid market in the world and I can exit my investments whenever I wish. I'm thankful that I have the freedom to speculate on crypto, opaque real estate deals, and can utilize excessive amounts of leverage if I so choose. And note, I don't actually do any of these things, nor do I recommend them to clients. I'm thankful that we have a well-established system for handling bankruptcy. If I blow myself up using any of the aforementioned strategies, I'll get a second chance. It also encourages talented entrepreneurs to keep trying to innovate and improve our world. I'm thankful that I live in a country with the safest and best run banking system in the world. If my cash is in any regulated bank, I know that it will not disappear and for the time being will earn a decent rate of interest. I'm thankful that for term life insurance so I can get the coverage I need without significantly impacting my cash flow. I'm thankful for permanent life insurance to plan for a large illiquid estates. I'm thankful for trusts that allow my clients to administer, manage, and protect their hard-earned assets. I'm thankful that interest rates are where they are, which makes buying a home more affordable for money. I'm thankful that simple strategies that help improve my portfolio performance over time, like diversification, dollar cost averaging, and rebalancing. I'm thankful I can easily access investments globally and can do so cost effectively. I'm thankful that fees on US based investment products are the lowest in the world as asset management firms compete for my and my clients' business. I'm thankful for 529 college savings accounts so I can start preparing now for my kids' higher education in a tax efficient manner. I'm thankful for disability insurance, which will protect my family if can't work or can no longer perform the same job function in the future. I'm thankful for tax loss harvesting, which is an important bright spot when an investor loses money on an investment. I'm thankful for favorable long-term capital gains rates, which encourages investors to buy and hold investments rather than day trade. I'm thankful that I have the flexibility to choose from a myriad of investment products and I'm not limited to a specific firm, product type, or investment strategy. I'm thankful to live in a market-based economy where anyone with a good idea, willingness to work hard, and a bit of luck can be successful. And before I forget, I want to thank all listeners and their families a wonderful Thanksgiving. Before jumping into this week's episode, I'd like to share that my upcoming fall live webinars will continue on Tuesday, December 4th at 8:30 a.m. featuring yours truly, Jonathan I. Shenkman, President and Chief Investment Officer of ParkBridge Wealth Management based in New York, but serving clients all over the country. And I'll be speaking on the final countdown, 2025 last minute wealth planning ideas. I'll be sure to include the registration information in the show notes to this episode. Okay, now for today's agenda. My talking points this week will discuss: should I invest in my friend's real estate deal? Our quote this week is from Warren Buffett's final shareholder letter. I'll spend the last half of the episode answering listener questions, including: do you think Mamdani's winning the New York City mayoral race will kill the city's title as the financial capital of the world? And finally, we'll end with an actionable idea to implement your investing life. We'll discuss year-end investment do's and don'ts. With that, let's jump into this week's talking points. So I received the following question recently, and went as follows. A friend approached me in Shul a few weeks ago, offering me access to a unique real estate deal where he can get me a family and friends discount. Returns are expected to be about 15%. He mentioned a few people in the community who invest with him. They are all sophisticated physicians or attorneys at major firms who are financially successful in their own right. The fact that he attracts sophisticated investors is a good starting point for my own due diligence, but how do I evaluate if this investment is a worthwhile opportunity? So this is actually a great question I receive with some regularity. The reality is that in the frum community, more investment dollars have been lost from participating in deals pitched by friends and family members than anything else. Of course, I don't have years of data to support this assertion, but anecdotally, it's hard to find someone of means who has not, at some point in their finances, that has not set their finances back by getting involved in an investment scheme pitched by someone in their social circle. That being said, let's dissect what I know about your scenario and offer some thoughts about how to evaluate these opportunities going forward. First, let's discuss investments to avoid. Many listeners may not have a background in investing and financial planning. However, you do have intuition. If something seems too good to be true or gives you an unsettling feeling, then take your time to get a second opinion or avoid it completely. A good rule of thumb is to avoid investment schemes where any of the following phrases are used in the sales pitch. One, access to a unique opportunity. Two, you'll receive a friends and family discount. Three, advertising consistent mid-teen returns. Your friend said all these phrases. Why are you so fortunate to be presented with such a unique opportunity? It's not because you're special or that your friend likes you more than others. It's likely because he needs your money and other pools of capital have dried up. Unless you have some information that supports why this real estate project is better than all the other ones that go south every year, I'd avoid it like the plague. If you invest, at best, you get your money back with a small return. However, the more likely scenario is you won't see your money back again. Next point is risk and returns. Risk and returns are inextricably linked. This is a timeless investment axiom. If you want to achieve the mid-teen returns that your friend is advertising, you need to take a lot of risk with your money. In plain English, higher risk means you have a higher probability of losing your money. If your friend is aiming for such high returns, then he intends to take a lot of risk with your money. For some reason, many high-income individuals think they have found the silver bullet of investing at high returns and no risk. This doesn't exist. If you want to make risky investments, then it should only be with a small portion of your portfolio. That way, in the likely event that this deal goes belly up, it won't derail your finances. Another point is your friends are irrelevant. Always remember that some of the most sophisticated people are also the worst investors. Success in one area of life does not necessarily transfer to other areas. While your friends may be successful in their field of expertise, it does not make them knowledgeable about evaluating real estate opportunities. Furthermore, they may have different goals, family dynamics, and financial circumstances than you. In short, what your friends are doing with their money should not be part of your due diligence process. Now, what to look for? If you made it this far in my answer and you're still not convinced that you should avoid your friend's offer, then you should at least attempt to assess the deal being proposed. You can start by asking some basic information, which will help assess whether this is a legitimate opportunity or just a way for your friend to speculate with your money. Be sure to ask for a few things. One, an audited 10-year track record. First, ask him for an audited performance track record from all the deals he's worked on over the past 10 years. If he doesn't have at least a decade worth of experience where he saw different market cycles or can't provide an audited track record from a legitimate third party, i.e., a major accounting firm, then you should avoid the project. Two, eating his own cooking. If he can provide these pieces of information and the numbers are satisfactory, then ask him how much of his own money is being put into this project. Never trust someone who won't invest a significant sum of their own money in the investment that they are proposing. Three, other factors. The next form of due diligence is personal. If everything checks out, you need to make sure this real estate project is suitable for your needs. Ask yourself the following questions. Will this investment help me achieve my goals? Does this investment make sense relative to my overall portfolio? What are the tax ramifications? What is the term of the investment? Assuming all these other items check out, perhaps you will want to proceed. Though I'd still suggest investing only a small portion of your overall portfolio, which is the prudent approach with any speculative investment. And here's the bottom line. The truth is, you can live your whole life, achieve all your goals, and amass a fortune without ever investing any special deals with family and friends discounts, mid-teen returns, and special access granted to you by a benevolent friend. Anything you want to accomplish in life can be done in the public markets, which offer liquidity and transparency. Keep in mind that the key to successful investing is not trying to achieve the highest possible returns. Rather, it's the ability to reach your financial goals. Increasing the probability of achieving your goals is done primarily by minimizing investing missteps. The reality is that most of these deals turn into financial disasters. The project implodes, the returns are drastically lower than anticipated, or something else doesn't go according to plan. Most people would benefit from having a policy to stick to a well diversified portfolio of publicly traded securities and let compounding work its magic. Let the big mockers in your community participate in these opportunities. You can stick with boring, plain vanilla investments and achieve everything you want in life with much less stress and risk. Okay, those are the talking points this week. And as a reminder, you can be notified of all the recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Warren Buffett. A couple weeks ago, Buffett wrote his final shareholder letter. For decades, he's been writing letters to shareholders, and they're always filled with wisdom and good perspective for both life and investing. And at 95 years old, Buffett has decided to step down as chairman of Berkshire Hathaway, making this his final letter. And I'd like to take an opportunity just to read the last page of the letter. And I think the reflections from the greatest investor in the world as he retires at 95 may be worthwhile. So this is Buffett speaking. One perhaps self serving observation. I'm happy to say I feel better about the second half of my life than the first. My advice: don't beat yourself up over past mistakes. Learn at least a little from them and move on. It is never too late to improve. Get the right heroes and copy them. You can start with Tom Murphy. He was the best. Back to Jonathan. Just for context, Tom Murphy was a legendary broadcasting executive and a close lifelong friend of Warren Buffett, who he often referred to Murphy as the best manager he ever encountered. Back to Buffett. Remember Alfred Nobel, later of Nobel Prize fame, who reportedly read his own obituary that was mistakenly printed when his brother died and a newspaper got mixed up. He was horrified at what he read and realized he should change his behavior. Don't count on a newsroom mix-up. Decide what you would like your own obituary to say and live the life to deserve it. Greatness does not come about through accumulating great amounts of money, great amounts of publicity, or great power in government. When you help someone in any of 1,000 ways, you help the world. Kindness is costless, but also priceless. Whether you're religious or not, it's hard to beat the golden rule as a guide to behavior. I write this as one who has been thoughtless countless times and made many mistakes, but also became very lucky in learning from some wonderful friends how to behave better. Still a long way from perfect, however. Keep in mind that the cleaning lady is as much a human being as the chairman. I wish all who read this a very happy Thanksgiving. Yes, even to the jerks, it's never too late to change. Remember to thank America for maximizing your opportunities, but it is inevitably capricious and sometimes venal in distributing its rewards. Choose your heroes very carefully and then emulate them. You will never be perfect, but you can always be better. Back to Jonathan. I'll let listeners draw their own conclusions from this letter. Hopefully, you can take away something to apply to your own life. And you can read the full Berkshire letter online, and I'll include a link to this in my show notes of this episode. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me and it may be answered in a future episode. Okay, first question. Now that Mamdani will be the next mayor of New York City, do you plan to leave the city? Also, do you think his winning will kill the city's title as the financial capital of the world? Will I leave? I've been out of New York City, and I've been in New York City, I should say, 10 times in the past 5 years. So I've already left. The issue is Mamdani has such a bad resume. He has literally accomplished nothing of significance other than working for his mom and jumped around a variety of other failed political campaigns. He has a resume that is worse than most college seniors, yet he was voted in to run the global capital finance. It's absolutely insane. In terms of killing New York City's distinction as the financial hub of the world, I think it has slowly been happening post-COVID as major financial institutions relocate to other parts of the country and more tax-friendly states. You tax the heck out of people, foster and promote anti-Semitism, don't prosecute criminals, and elect socialists to lead us, you're actively trying to kill everything great about New York. And to be honest, it's quite sad. Next question. I have enough money to retire. My question is not how to aggressively grow my money, since that's unnecessary. Rather, how do I maintain and preserve it? Okay, in order to preserve your funds in retirement, it's essential to position your portfolio to one, outpace inflation, and two, to weather the inevitable market downturn. In order to do that, you will need a meaningful percentage of equity exposure. That the exact amount depends on your circumstances. You'll also need to create something called a bond tent, which is essentially enough cash and high quality bonds that could be used to pay your bills for a couple of years in case the market plummets in value and doesn't recover for a few years. So you don't need to withdraw funds in a down market. Beyond that, I would say avoid high risk investments that have the potential for high returns, but also have a high probability to blow up. You are not at the point where you need to take the risk. No one actually needs to take that type of risk. I would also avoid other types of missteps folks make with their money, like overspending, lending money to a deadbeat relative, etc. This framework may seem overly simplistic, but it's correct to answer your question. Next question. I'd like to open IRAs for my kids. Are there any restrictions on how much I could put in for them? Yes, you are restricted to how much income they earn a year and the annual contribution limit. So if Junior makes $1,000 babysitting and you want to get him started on saving for retirement, you can only contribute $1,000 towards Roth IRA because that's the amount he earned. On the other hand, if Junior made $10,000 this year as a social media influencer, you can contribute $7,000, which is annual limit one can contribute to an IRA in 2025. Next question. What's the difference between backwardation and contango? Contango. This is a type of question that has come up once or twice before, but is still applicable to approximately zero people listening. That being said, both words sound pretty cool, and will instantly make you the star of any kiddish club, so it's certainly worth addressing. Backwardation is a market condition where the current price, i.e., spot price of a commodity or asset, is higher than the price of its future contracts. In other words, people are willing to pay more to get the asset now than to lock in a price for delivery later. This usually happens when there's a surge in immediate demand of a short term supply crunch, i.e., a sudden oil shortage or crop failure. Traders might rush to buy now, pushing up the spot price while futures prices remain lower because the market expects the situation to normalize. The opposite of backwardation is called contango, where future prices are higher than the spot price, often due to shortage cost or expectations of rising prices. And here's a bonus tip. Memorize the following, which can be used at your kiddish club to impress the chevra. And it goes like this. You know, in oil markets, when it's in backwardation, it usually means the immediate demand's hot, tight, and supply, right? But when we slip into contango, it's like the market's saying, relax, we've got barrels to spare and places to stash them. Kind of poetic, isn't it? Markets dancing between scarcity and surplus. Speaking of scarcity, my shot glass is empty. Pass the shivas, bavakasha. I hope that explanation and that script will be helpful at Kiddush this Shabbos. Next question. What's a safe amount to invest in my own company's stock? The culture here is to invest a significant amount, but what do you think as it relates to one's overall finances? You know, the culture of Enron was to put 100% of their contributions into 401k in Enron stock. It didn't work out too well. I also had a colleague at a previous employer who put 100% of his 401k contribution into his company stock, and that was a year before the financial crisis. Mind boggling. I believe if you are employed by a company, you already have a lot vested in them, i.e., your paycheck, and don't necessarily need to invest more money into it. That's why I typically tell people not to invest more than 10% of their investable assets into their company. When I worked for large financial institutions, I put 0% of my capital into the firm I worked for and immediately liquidated the shares I received once I was vested. I didn't exactly think super highly of these institutions either. However, there's no one size fits all type of advice for this. If you work at an innovative startup and are very confident that it will become the next Amazon, you may want to bet more on it. The one thing I would advise is to make sure you are also saving a significant portion of your income in a diversified portfolio outside of your company. Granted, this will prevent you from becoming the largest shareholder of the company. However, it will also ensure that you won't end up in the poorhouse if it becomes the next WeWork or Enron. Being able to sleep at night knowing that you don't have too much of your net worth locked up in one investment is one of the cornerstones of proper financial management. Invest prudently, my friends. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me. Perhaps my team and I can help you. And the best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I'd like to end with a timely and actionable idea or multiple ideas that investors can implement to their financial lives. And today's timely idea is going to focus on year-end investment do's and don'ts, and I'm going to share a few of them with you. First, do consider rebalancing your portfolio. Many parts of the market went up in 2025. However, there are many individual investments within your portfolio that went down or didn't go as much as other areas. This may include REITs, small cap stocks, and investment grade bonds, all of which have underperformed the S&P 500 in international markets. Interestingly, international markets actually trounced the performance of the S&P 500 this year, so keep in mind that it always pays to diversify. Given these market dynamics, many investor portfolios are probably out of whack, and it may make sense to rebalance your portfolios to ensure that your allocation is brought back to its appropriate risk tolerance. In addition to risk management, Rebalancing is also a great way to one, potentially lock in some losses for tax planning purposes, and two, add the proceeds to your losing positions that may appreciate meaningfully in the future. Next point is don't chase past performance. Today and every day is a good reminder to stay away from the current hot strategy du jour. Every year, there's always some investment that did phenomenally well. Unfortunately, it's impossible to know beforehand which manager strategy or index that will be. This won't stop aggressive salesmen from capitalizing on recent success, touting great returns, and encouraging investors to invest in yesterday's winners. In particular, you see this in private credit, which has been a darling to many investors for some time. However, this year, there have been many stories of private credit taking quite the beating. As I always try to emphasize to my clients, the market moves in cycles. One year's winners are oftentimes losers in the following years. The key is to stick with a proper asset allocation, plain vanilla investments that will allow you to achieve your goals. Chasing past performance will not work out in the long term. And here's one more year-end planning tip, which is to automate your investment process for the coming year. You shouldn't have to manually move money into your investment accounts multiple times a year. I try to encourage all my clients to automate their deposits into their various accounts. I practice what I preach, and I do this with my own accounts as well. Automation helps remove emotions from your investment process so you can just keep investing regardless of how the market is performing. Over time, this strategy works out quite well. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.